Hi there, welcome to Kneppy Invest. I'm recording this on the 2nd of January. Can't believe I had to look at my watch to know the date because yesterday was New Year's Day. Anyway, I am recording this on the 2nd of January, which means the half year for the financial year is over. And the next few months are very exciting months for investors because in January we'll see many companies, particularly small cap companies, release Appendix 4Cs, and more than likely the first Appendix 4C could be released in the next trading week. I'll put my money on XREF, XF1. The last 3 quarters, they've released their Appendix 4C on the 6th of the month, which would mean this coming Thursday. Last January, they released it on the 19th. But they've had really good quarters the last few, and more than likely management want to get the results out as soon as possible, because if you get out first, or maybe not first, but you get out in the first few weeks of the month, all eyes are on that report. If you get it or release it on the last day of the month, there's so many companies releasing their reports that you won't find as many eyes on the report. So if they have another good quarter, more than likely XREF will release it in the next week or a half. I think no later than the 10th or 11th if it's a good report. Another company that might release their Appendix 4C is going to be Self-Wealth. They are notoriously, and that's notoriously on the good end, they're notorious for releasing their Appendix 4C quite early as well. And then we go into February, which is reporting season for most companies on the ASX, not all the companies, but we'll say the majority of companies will either report their half-yearly or yearly results. And I love that time of year. I love reading financial statements from companies. I love to see how companies are performing. So really looking forward to see all these Appendix 4Cs and half-year and full-year results being released over the next 2 months. But because we are at the end of the half year, that means, in the month of December, that means I do have to give an update to the performance of 3 portfolios. And those 3 portfolios, for those who don't know, are a group portfolio, which consists of about 25 to 30 companies. I can't remember exactly how many companies that were chosen by viewers of this channel. And I pose a question to those viewers. If you had to pick 3 companies that you thought will become absolute winners over the next 5 years, what would those 3 companies be? Then I collated the results, and then I came up with a hypothetical portfolio of 25 to 30 companies, and it is a completely passive portfolio, no buying or selling of any companies within that portfolio. And the couple of reasons I want to do that is I have heard that complete passive portfolios can achieve quite good results over the long term. I just want to test that. And also want to test it against 2 of my own investing strategies, and they are a short-term settlement strategy, which I have developed over the past few years, and I'm starting to use more and more. And in fact, this strategy, I actually like using it more than my traditional strategy, which is the long-term buy and hold. And that's the sort of strategy I started with when I started investing well over a decade ago. It has performed fairly well for me, but I do think there are some flaws in buying companies for the long term and just holding them throughout 5 or 10 years, even if they are going up, because there are going to be periods when the share price falls quite a bit. And if you can cut out those periods when the share price falls, overall your performance will be superior. And that's where testing the short-term sentiment strategy comes into play. First thing I always do in these portfolio performance updates is to look at the charts. Now, when I first started doing these videos, I was only looking at the daily chart, but then I realized since I'm doing these videos every month, I should be looking at the monthly chart. So this is the XJO going all the way back to 2004. You can see the great period between 2004 and the GFC, when most markets around the world were going up like crazy. And then the GFC saw the markets around the world fall for about an 18-month period. So if you thought the COVID-19 crash was horrendous, just keep in mind that people who invested back in 2008 into 2009 had saw the markets fall over an 18-month period instead of just a 1-month period for the COVID-19 financial panic. And then the bottom of the GFC was almost directly in line with the long-term uptrend, which is that sloping blue line. As soon as the XGO touched the long-term trend line, we saw a bit of a correction to the upside in the market. Maybe correction should be only when the stock market goes down. I don't know. Anyway, since then, since the bottom of the GFC, we've been trading in this upward sloping channel. And the only time we've been out of that channel was during the COVID-19 financial panic. But we recovered very quickly. And then we zoomed up to the top of the channel over about 11, 12-month period. In fact, we had a period of time when the market was up 11 months in a row. But we had seen up until December, the market down 3 months in a row. So those months were September, October, and November. But the markets did rally quite well in December and overall was up 2.6% and finished at 7,444.6. Before we talk about how the group portfolio performed in December, I just want to go back to November. And at this point, at the end of the 5-month period, the group portfolio was up $20,515 or 20%, which totally was beating the market, which was up about 1 or 2%. If you take into account dividends, I think it was up maybe 2%. So the group portfolio, this sort of strategy, we ask a group of people their favorite companies or those companies they think will outperform the market over a 5-year period, is performing quite successfully. And the main reason the group portfolio was performing was because of 2 companies, Novonix and Lake Resources. Combined, those 2 companies were up $24,000, which means the rest of the companies in this portfolio were down about $4,000. So let's see how the group portfolio performed in December, noting that how Novonix and Lake Resources perform will have a big effect on the overall group portfolio performance. And unfortunately, the group portfolio was down about $5,000 for December, all because Novonix was down about $5,000. Again, the performance of the group portfolio is highly correlated, we'll say correlated to the performance of Novonix and to a smaller extent to the performance of Lake Resources. In fact, Lake Resources was up for the month, so maybe there's less correlation when it comes to Lake Resources. But combined, Novonix and Lake Resources up $20,500. That means the rest of the portfolio is down $5,000 over the last 6 months. And this just shows you, or should show you, the benefits of having a diversified portfolio. All you need is 1 or 2 companies in your diversified portfolio to perform, and you can significantly outperform the market. Now, it's very important to compare the performance of any of your portfolios to the overall market or a benchmark. So in this case, I'm comparing all 3 portfolios to the STW, which mirrors the ASX 200. And of course, the group portfolio right now is significantly outperforming the market by not quite 4 times, but we'll say about 3 times. So the group portfolio overall return 15.22%, which is 14.2% capital gains and 1% dividends. The STW is up 4.68%, which includes 1.64% capital gain and 3% dividend. And on the top there, we can see how the group portfolio has performed against the STW on a rolling basis since the start of July. And you'll notice some dips in the group portfolio, and that's when the Novonix share price takes a bit of a tumble. And whenever you see the group portfolio going up again, that's when the Novonix share price starts rising. So there is a little bit of correlation between the performance of the group portfolio and the performance of Novonix at this point in time. Now on to my own personal short-term sentiment portfolio, which uses a sentiment strategy. So I'm looking at positive sentiment, changes in trends for companies. There was a period of time, about a 2, 3, or even 4-month period, where I was paying very little attention to this portfolio, and it was seriously underperforming the market. So the performance of portfolios all depends on your strategy. And if you go against the strategy, then more than likely you will underperform the market. And so in this strategy, I'm a little bit more active. So if you become less active, then you will start underperforming the market. If you have a passive portfolio and you start being a little bit more active, there is a chance you might start underperforming the market. So in this strategy or this portfolio, I want to be a little bit more active. Take advantage of shifts in sentiment, shifts in trend. And there was a 3-month period where I was not active at all. And in fact, at one point in time, the performance of this portfolio was negative. I've started to be a little bit more active, paying close attention to the charts and that sort of thing. And I did make 3 disposals during the month: Whisper, AIM, and Stonehorse Energy. AIM is AI Media. And I made 6 purchases: Neuron, Magnus, ERM, which is Emerson, Mosaic Brands, VR1, which is Vection Technologies or something like that, and Clover Corporations. A couple of those companies are performing quite well since I bought. Now, I had plenty of cash, about $50,000 of cash at the end of November. So I do have to deploy that cash, because the more cash you have on hand, the less chance you have to outperform the market. So $6,900 of disposals and almost $14,000 of purchases, no dividends in the month. And when you just have a look at the active companies within this portfolio, at this point in time, the performance of those companies up $8,711. By far, the best performing company is Johns Lyng Group. Return almost double initial investments. OFX Group performing very well. And South32, which I've had in this portfolio since August 2020, that's up quite a bit too. So you can see the motto is hang on to your winners, sell out of your losers, and that's actually what I'm doing. So for example, Whisper, AI Media, and Stonehorse Energy were 3 of the companies that were my losing companies. I was thinking of selling Johns Lyng Group because they went up in share price by 20% on the back of an acquisition, but the share price has kept on rising since then. So that would have been possibly a foolish move. A lot of positive sentiment behind this company at this point in time. So overall, the companies I've been holding in this portfolio right now are up over $8,700. But although the performance of the companies I have currently in this portfolio are up about $8,700, the overall performance is a little bit lower than that because I have sold out of some of my losers. So at this point in time, the capital gains for the short-term sentiment at 4.6%, dividends 0.9%, and combined total returns for this portfolio is at 5.5% compared to the overall market, or the STW, up 4.7%. I do want to double the market returns, and that is my ultimate goal. But if you did ask me what I'll say that's the preferable goal, but if you did ask me what the ultimate goal is, it's just to beat the market. And you can see a period of time when the short-term sentiment or portfolio did not go well, and that was from start of September all the way towards the end of November, or say the middle of November, when I started being a little bit more active. So again, it's very important to sort of follow your strategy. If you have a more active strategy, make sure you are active. If you have a more passive strategy, make sure you are passive and not active. And since I've become a little bit more active in this strategy, this portfolio has outperformed the market by quite a bit since the start or since the middle of November. If you had to ask me right now what my preferred strategy is, I'd probably lean quite a bit towards my sentiment and trend strategy, even though the personal long-term strategy I have been doing for well over 10 years. For some reason, I just find looking at companies' charts, buying into companies, even the sort of companies where I'd never buy or put into my long-term portfolio, just hanging on to those companies for a little bit of time, like the OFX Group, Blue Scope Steel I held for a while, and that performed very well. Even South32, more than likely, I've never held in my long-term portfolio. Just holding those companies when they are performing quite well for a period of time, maybe a short, medium, or even long period of time, I do find a little bit more enjoyable. And one of the other reasons I do find a little bit more enjoyable is because the share prices of those companies are going up. And there are a few companies in my long-term portfolio that are not performing very well, including Zip, Electro Optics, Orbital Corp, SciDev, very disappointing performance because of a capital raising, which was a really bad capital raising by the management. X Tech, even Kogan is at the bottom there. And some of the best performing companies in this portfolio: EnviroSuite, ACL, which is Australian Clinical Labs, XREF, which is a company that should be releasing their Appendix 4C in the next week and a half. The performance of those companies are not like we have seen with Novonix and even Lake Resources. So I haven't had that really stellar performances yet in my portfolio. In fact, the best performing companies I have had in this portfolio have actually sold, and that includes Beam Communications and Revison. I did make 3 disposals of companies whose trends are going down. So I have incorporated some of my strategies that I am using in my short-term portfolio into this portfolio. So maybe in the future I can combine the two. And the 3 companies I did sell are LGL, which is Lynch Group, Pay Group, and Straker. And combined with those disposals and no acquisitions in the month, I have almost $6,400 of cash at the end of the half year. Even though it might seem like I am a bit bearish on using this long-term strategy, long-term buy and hold strategy, it has performed quite well since the start of July, since the start of the financial year, up 16.71%, not quite quadruple the performance of the STW. So I should be happy with the performance of this portfolio and this strategy. But in saying that, there was a 7-week period from the middle of October towards the end of December when the performance of this portfolio was down over that period of time. So there was a 7-week consecutive period of time when the performance of this portfolio was down. Now, in the last week, it has corrected itself and it's still performing quite well over the last 6 months. But that could be one of the reasons why I'm a little bit bearish about using this strategy and about this portfolio, and why I'm thinking of combining both my strategies into the one. And there is a possibility, if I do that, that I could supercharge my returns over the long term, medium term, and even the short term. So that's one of the reasons why I am thinking of combining both strategies into the one strategy, sort of a supercharged strategy, we'll call it. Now we can compare the performance of the 3 portfolios to the STW for the 6-month period from the 1st of July. In brackets here was the performance of all 4 of these to the end of November. You can see the STW was only up 1.72% at the end of November and now is up 4.68%. So the overall markets had a really good December. The group portfolio down from 20.52% up to 15.22%. A good chance that we'll see it rebound in January. Now that's depending on the overall market. Maybe there's going to be a tech crash, that sort of thing, which would see most of these portfolios down a fair bit. Short-term sentiment was the best of the 3 portfolios, up from 3.24% to 5.53%. And my long-term buy and hold strategy was up for December, but only slightly, up 16.19% to 16.71%. It's always good to have goals, and 2 of my goals for January include deploying more of my short-term cash. I have over $40,000 I need to deploy, but I do want to use patience. Now, in saying all that, I have a lot of ideas right now, which I've discovered over the last few days, including Adairs, Austell Group, PFG, QIP, Steadfast and AUB Group, and even Macca. So a lot of those companies, looks like there's either a shift in sentiment from neutral to positive potentially, or for like Steadfast, AUB Group, and a few other of those companies, we are in a long-term trend. It looks like that trend could continue for a while. I got a few other companies I am looking at: Cobalt Blue, Stavely, and Sierra Resources. In particular, Sierra Resources had a good announcement the other day, and the share price keeps going up, which shows me there's a fair bit of strength with that announcement. I think that announcement was in regards to an agreement with Tesla, so no wonder why the market is bullish in regards to that company. The other thing I want to think about for January is how to combine my long-term and my short-term strategy into the one, sort of like a unified theory of physics, that sort of thing. So unified strategy, combining the short-term and the long-term strategies into the one. That's all I have for this half-year performance update for the 3 portfolios. They're all outperforming the market at this point in time, and exactly what we want to see, because if we can't outperform the market, we may as well just put our money into ETFs. If you have any questions about the strategy I use, companies I've shown you today, or anything I've been talking about, like combining my 2 strategies, I'd love to hear your opinion. So leave it in the comment section of this video. Last thing I always have to mention is I'm not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a great day. Have a great new year.